So now let's go over here.
Hello, Mr. Buffett. I got two short questions. One is, how do you find intrinsic value in a company?
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it, or what the volume in the stock is, or what the chart looks like, or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset, oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business, because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those. Number two.
So you got formulas involved in finding intrinsic values on certain companies. I mean, you've got a mathematical system set up.
Discounted present value of future cash, yeah.
Okay. Second short question is, why haven't you written down your set of formulas or your strategies in written form so you can share it with everyone else?
Well, I think I actually have written about that. If you read the annual reports over the recent years, in fact, the most recent annual report, I use what I've just been talking about. I use the illustration of Aesop. Because here Aesop was in 600 BC. Smart man, wasn't smart enough to know it was 600 BC, though. I mean, would take a little foresight. But Aesop, in between tortoises and hares and all these other things, he found time to write about, birds. And he said, a bird in the hand is worth two in the bush. Now, that isn't quite complete, because the question is, how sure are you that there are two in the bush? And how long do you have to wait to get them out? Now, he probably knew that, but he just didn't have time because he had all these other proverbs to write and had to get on with it. But he was halfway there in 600 BC. That's all there is to investing, is how many birds are in the bush, when are you going to get them out, and how sure are you? Now, if interest rates are 15%, roughly, you've got to get 2 birds out of the bush in 5 years to equal the bird in the hand. But if interest rates are 3% and you can get 2 birds out in 20 years, it still makes sense to give up the bird in the hand, because it all gets back to discounting against an interest rate. Problem is, often you don't know, not only how many birds are in the bush, but in the case of the internet companies, there weren't any birds in the bush. But they still take the bird that you give them in the hand. But I actually have written about this sort of thing, and stealing heavily from Aesop, who wrote it some 2,600 years ago, but I've been behind on my...
Charlie?
I would argue that one filter that's useful in investing is the simple idea of opportunity cost. If you have one opportunity that you already have available in large quantity and you like it better than 98% of the other things you see, well, you can just screen out the other 98% because you already know something better. So that people who have a lot of opportunities tend to make better investments than people that don't have a lot of opportunities, and people who have very good opportunities, and using a concept of opportunity cost, they can make better decisions about what to buy. With this attitude, you get a concentrated portfolio, which we don't mind. That practice of ours, which is so simple, is not widely copied. I do not know why. Now, it's copied among the Berkshire shareholders. I mean, all of you people have learned it. But it's not the standard in investment management, even at great universities and other intellectual institutions. Very interesting question. If we're right, why are so many eminent places so wrong?
There are several possible answers to that question.
Yes.
The attitude, though, I mean, if somebody shows us a business, the first thing goes through our head is, would we rather own this business than more Coca-Cola? Would we rather own it than more Gillette? It's crazy not to compare it to things that you're very certain of. There's very few businesses that we'll find that we're certain of the future about as companies such as that. And therefore, we will want companies where the certainty gets close to that. And then we'll want to figure that we're better off than just buying more of those. If every management, before they bought a business in some unrelated field that they might not have even heard of, more than a short time before that's being promoted to them, if they said, is this better than buying in our own stock? Is this better than even buying Coca-Cola stock or something? There'd be a lot fewer deals done. But they tend not to measure against what we regard as close to perfection as we can get. Charlie, anyone?
Well, I will say this, that the concept of intrinsic value used to be a lot easier because there were all kinds of stocks that were selling for 50% or less of the amount at which you could have easily liquidated the whole corporation if you owned the whole corporation. Indeed, in the history of Berkshire Hathaway, we bought things at 20% of then liquidating value. And in the old days, the Ben Graham followers could run their Geiger counters over corporate America, and they could spill out a few things, and you could easily see, if you were at all familiar with the market prices of whole corporations, that you were buying at a huge discount. Well, no matter how bad the management, if you're buying at 50% of asset value or 30% or so on down, you have a lot going for you. And as the world has wised up and as stocks have behaved so well for people that stocks generally have gone to higher and higher prices, that game gets much harder. Now to find something at a discount from intrinsic value, those simple systems ordinarily don't work. You've got to get into Warren's kind of thinking, and that is a lot harder. I think you can predict the future in a few places, best if you understand a few basic ideas that come from a good general education. And that's what I was talking about in that talk I gave at the USC Business School. In other words, Coca-Cola is a simple company if it's stripped down and analyzed in terms of some elemental forces. It's not hard to understand Costco either. You know, I mean, there are certain fundamental models out there that do not take, you don't have the kind of ability that quantum mechanics requires. You just have to know a few simple things and really know them.
Charlie talks about liquidating value. He's not talking about closing up the enterprise, but he's talking about what somebody else would pay for that stream of cash, too. I mean, if you could have looked at a collection of television stations owned by a Cap Cities, for example, in the early to mid, 1974, and it would have been worth, we'll say, 4 times what the company was selling for. Not because you'd close the stations, but just their stream of income was worth that to somebody else. It's just that the marketplace was very depressed, although, like I say, on a negotiated basis, you could have gone and sold the properties for 4 times what the company was selling for, and you got wonderful management. And I mean, those things happen in markets. They will happen again. But part of investing and calculating intrinsic values is if you get the wrong answer when you get through. In other words, if it says don't buy, you can't buy just because somebody else thinks it's going to go up or because your friends have made a lot of easy money lately or anything of the sort. You have to be able to walk away from anything that doesn't work, and very few things work these days. You also have to walk away from anything you don't understand, which in my case is a big handicap.
But you would agree with Joe Warren that it's much harder now.
Yeah, but I would also agree that almost at any time over the last 40 years that we've been up on a podium, we would have said it was much harder in the past, too. But it is harder now. It's way harder. Part of it being harder now, too, is the amount of capital we run. I mean, if we were running $100,000, our prospects for returns would be, and we really needed the money, our prospects for return would be considerably better than they are running Berkshire. It's very simple. Our universe of possible ideas would expand by a huge factor. We are looking at things today that, by their nature, a lot of people are looking at. And there were times in the past when we were looking at things that very few people were looking at. But there were other times in the past when we were looking at things where the whole world was just looking at them kind of crazy. And that's a decided help.
I'm Keith Pryor from San Francisco. I have a question. When you're valuing the companies and you discount back the future earnings that you talked about, how many years out do you generally go? And if you don't go out a general number of years, how do you arrive at that time period?
Well, that's a very good question, and it's the heart of investing or buying businesses, which we regard as the same thing. And it is the framework in which we operate. I mean, we are trying to look at businesses in terms of what kind of cash can they produce if we're buying all of them, or will they produce if we're buying part of them, and there's a difference. And then at what discount rate do we bring it back? And then I think your question was how far out do we look and all that. Despite the fact that we can define that in a very kind of simple and direct equation, you know, we've never actually sat down and written out a set of numbers that to relate that equation. We do it in our heads in a way, obviously. I mean, that's what it's all about. But there's no piece of paper, and there never was a piece of paper that shows what our calculation on Helzberg's or See's Candy or the Buffalo News was in that respect. So it would be attaching a little more scientific quality to our analysis than there really is if I gave you some gobbledygook about, well, we do it for 18 years and stick a terminal value on and do all of this. We are sitting in the office thinking about that question with each business or each investment, and we have discount rates in a general way in mind, but we really like the decision to be obvious enough to us that it doesn't require making a detailed calculation, and it's the framework, but it's not applied in the sense that we actually fill in all the variables. Is that a fair way of stating it, Charlie?
Yeah. Berkshire is being run the way Thomas Hunt Morgan, the great Nobel laureate, ran the biology department at Caltech. He banned the Frieden calculator, which was the computer of that era. And people said, how can you do this? Every place else in Caltech, we have Frieden calculators going everywhere. And he said, well, we're picking up these great nuggets of gold just by organized common sense, and resources are short, and we're not going to resort to any damn placer mining as long as we can pick up these major aggregations of gold. That's the way Berkshire works, and I hope the placer mining era will never come. Somebody once subpoenaed our staffing papers on some acquisition, and of course, not only did we not have any staffing papers, we didn't have any staff.
Hi, Dan Kurz from Bonita Springs, Florida. You've given many clues to investors to help them calculate Berkshire's intrinsic value. I've attempted to calculate the intrinsic value of Berkshire using the discounted present value of its total look-through earnings. I've taken Berkshire's total look-through earnings and adjusted them for normalized earnings at Geico, the Supercat business, and General Re. Then I've assumed that Berkshire's total look-through earnings will grow at 15% per annum on average for 10 years, 10 years per annum for years 11 through 20, and that earnings stop growing after year 20, resulting in a coupon equaling year 20 earnings from the 21st year onward. Lastly, I've discounted those estimated earnings stream at 10% to get an estimate of Berkshire's intrinsic value. My question is this a sound method? Is there a risk-free interest rate, such as a 30-year Treasury, which might be the more appropriate rate to use here, given the predictable nature of your consolidated income stream? Thank you.
Well, that is a very good question, and because that is the sort of way we think in terms of looking at other businesses. Investment is the process of putting out money today to get more money back at some point in the future. And the question is, how far in the future, how much money, and what is the appropriate discount rate to take it back to the present day and determine how much you pay. And I would say you've stated the approach. I couldn't state it better myself. The exact figures you want to use, whether you want to use 15% gains in earnings or 10% gains in the second decade, I have no comment on those particular numbers, but you have the right approach. We would probably use a lower discount factor in evaluating any business now under present day interest rates. Now, that doesn't mean we would pay that figure once we use that discount number, but we would use that to establish comparability across investment alternatives. So if we were looking at 50 companies and making the sort of calculation that you just talked about, we would use we would probably use the long-term government rate to discount it back, but we wouldn't pay that number after we discounted it back. We would look for appropriate discounts from that figure. But it doesn't really make any difference whether you use a higher figure and then look across them, or use our figure and look for the biggest discount. You've got the right approach, and then all you have to do is stick in the right numbers. And you mentioned in terms of our clues, we try to give you all of the information that we would find useful ourselves in evaluating Berkshire's intrinsic value. In our reports, I can't think of anything we leave out that if Charlie and I had been away for a year and we were trying to figure out, look at the situation fresh, evaluate things, there's nothing, in my view, left out of our published materials. Now, one important element in Berkshire, which is a secondary factor that gets into what you're talking about there, is that because we retain all earnings and because we have a growth of float over time, we have a considerable amount of money to invest. And it really is the success with which we invest those retained earnings and growth and float that will have an important factor in how fast our intrinsic value grows. And to an important extent, what happens there is out of our control. I mean, it does depend on the markets in which we operate. So if our earnings
plus float growth equals $3 billion or something like that in a current year. Whether that $3 billion gets put to terrific use, satisfactory use, or no use at all virtually, really depends to a big extent on external factors. It also depends to some extent on our energy and insights and so on. But the external world makes a big difference in the reinvestment rate. And, your guess is as good as ours on that. But if we run into favorable external circumstances, your calculation of intrinsic value would result in a higher number than if we run into the kind of circumstances that we've had the last 12 months. Charlie?
Yeah, for many decades around here, we've had roughly 100%, more than 100% of book net worth in marketable securities, and had a lot of wonderful wholly owned subsidiaries to boot. And we've always had a very attractive place to put new money in as we generate it. Well, we still got the wonderful businesses, but we're having trouble with the new money. So it's not trouble really to have a pile of lovely money. This is not. I don't think there should be tears in the house.
Have you ever run into any unlovely money, Charlie?
Yeah, well, it isn't a multiple of today's earnings that is primarily determinant of things. We bought our Coca-Cola, for example, in 1988 and 89 on this stock at a price of $11 a share, which as low as 9, as high as 13, but it averaged about $11. And it'll earn, we'll say, most estimates are between $2.30 and $2.40 this year. So that's under 5 times this year's earnings, but it was a pretty good sized multiple back when we bought it. It's the future that counts. It's like what I wrote there, what Wayne Gretzky says, to go where the puck is going to be, not where it is. So the current multiple interacts with the reinvestment of capital and the rate at which that capital is invested to determine the attractiveness of something now. And we are affected in that valuation process to a considerable degree by interest rates, but not by whether they're 7.3 or 7.0 or 7.5. But I mean, we will be thinking much differently if their long-term rates are 11% or 5%. And but we don't have any magic multiples in mind. We're thinking we want to be in the business that 10 years from now is earning a whole lot more money than it is now, and that we will still feel good about the prospects of the business at that time. That's the kind of business we're trying to buy all of, and that's the kind of business that we try and buy part of. And then sometimes we buy others too. Charlie?
We don't do any of that rigid formulaic stuff.
There's a general framework that you can call a formula in our mind, but we also don't kid ourselves that we know so much about the specifics that we would actually make a calculation in terms of the equation. When we bought Coke in 88 and 89, we had this idea about what we thought the business would do over time, but we never reduced it to making a calculation. Maybe we should, but we don't think there's that kind of precision to it. We think it's the right way to think in a general way, and we think if you think that you can do it to pinpoint it, you're kidding yourself, and therefore we think that when we make a decision, there ought to be such a margin of safety that it ought to be so attractive that you don't have to carry it out to 3 decimal places.
Well, I can't give you a formulaic approach because I don't use one. And I just mix all the factors, and if the gap between value and price is not attractive, I go on to something else. And sometimes it's just quantitative. For instance, when Costco was selling at about 12 or 13 times earnings, I thought that was a ridiculously low value just because the competitive strength of the business was so great and it was so likely to keep doing better and better. But I can't reduce that to a formula for you. I like the cheap real estate. I like the competitive position. I liked the way the personnel system worked. I liked everything about it. And I thought, even though it's 3 times book or whatever it was then, that it's worth more. But that's not a formula that anybody... If you want a formula, you should go back to graduate school. They'll give you lots of formulas that won't work.
This is the longest we've ever gone in the Berkshire meeting without Charlie saying that, getting to the point where he prefers Costco to Berkshire. If we could see in it, looking at any business, what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years, or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick an appropriate risk rate in. Or you can compare one government bond with 5% coupons to another government bond with 7% coupons. Each one of those bonds has a different value because they have different coupons printed on them. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. As we have said, in high-tech businesses or something like that, we don't have the faintest idea what the coupons are going to be. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years. When we bought See's Candy in 1972, we had to come to the judgment as to whether we could figure out the competitive forces that would operate, the strengths and weaknesses of the company, and how that would look over a 10 or 20 or 30-year period. And if you attempt to assess intrinsic value, it all relates to cash flows. The only reason for putting cash into any kind of an investment now is because you expect to take cash out. Not by selling it to somebody else, because that's just a game of who beats who, but by, in a sense, by what the asset itself produces. That's true if you're buying a farm. It's true if you're buying a business. And the filters you described, there are a number of filters which say to us, we don't know what that business is going to be worth in 10 or 20 years, and we can't even make an educated guess. Obviously, we don't think we know to 3 decimal places or 2 decimal places or anything like that, precisely what's going to be produced. But we have a high degree of confidence that we're in the ballpark with certain kinds of businesses. The filters are designed to make sure we're in those kinds of businesses. We basically use long-term, risk-free, that's government bond type interest rates to think back in terms of what we should discount at. And you know, that's what the game of investment is all about. Investment is putting out money to get more money back later on from the asset, and not by selling it to somebody else, but by what the asset itself will produce. If you're an investor, you're looking at what the asset is going to do, in our case, businesses. If you're a speculator, you're primarily focusing on what the price of the object is going to do, independent of the business, and that's not our game. So we figure if we're right about the business, we're going to make a lot of money, and if we're wrong about the business, we don't have any hopes. We don't expect to make money. And in looking at Berkshire, we try to tell you as much as possible as we can about our business, of the key factors. Those are the things that Charlie and the things we put in our report about those businesses are the things that we look at ourselves. So if Charlie had nothing to do with Berkshire, but he looked at our report, he would probably, in my view, he would come to pretty much the same idea of intrinsic value that he would come to from being around it, you know, for X number of years. The information should be there. We give you the information that if the positions were reversed, we would want to get from you. And in companies like Coca-Cola or Gillette or Disney or those kind of businesses, you will see the information in the reports. You have to have some understanding of what they're doing, but you have that in your everyday activities. You'll get that kind of knowledge. You won't get it, in terms of some high-tech company, but you'll get it with those kind of companies. And then you sit down and you try to print out the future. The second part of your question relating to intrinsic value going down, actually, if you compute intrinsic value as reflecting the discounted value of future cash flows, that should have built into it a calculation that allows for the fact that certain businesses are going to earn less in the future than now. It isn't that their intrinsic value goes down then, because you should build it into your calculation right now. But as we've pointed out many times in the past, intrinsic value is terribly important and very fuzzy. And we do our best to work in the kind of businesses where we think that we have the highest probabilities, where our predictions are of a fairly highly probable nature. And that leaves out all kinds of companies. It's pretty good, we'll say, it's something like a natural gas pipeline. I mean, the chances of big surprises in a pipeline should be relatively small. That doesn't mean they're zero, but they're relatively small. Now let's assume that you had a gas pipeline, which some have, where either the supply of gas is going to run down, or where there are competitive pipelines that may be trying to take away your contracts that you wrote 10 years ago and expire in 2 years, and you're going to have to cut prices. I would say that 2 years from now, when you have to cut prices, the intrinsic value hasn't gone down from today if you properly calculate it today and build in the fact that profit margins in the future will be lower than today. We looked at a pipeline recently where we think they are going to be vulnerable to competitive price pressures because of alternate ways of getting gas to market through other pipelines. And the calculation is entirely different. The calculations is different. The results are different in terms of that pipeline versus a pipeline that is the low-bring gas from one market to another and will remain the low-cost producer. But it isn't. If properly calculated, you build in the prediction of decline in future operating earnings. You don't wait till you get there to anticipate it. Charlie's famous for saying that all he wants to know is where he's going to die, so he'll never go there. Well, that's part of predicting in business. I mean, I really have never seen an investment banker's book. I hope to see one someday, and I hope I can survive the shock when I do see it, where the earnings of the business being offered go down. Lots of businesses' earnings go down, and they're going to go down. And I get all this nonsense, where they project it out for 10 years, and it always goes up. It just isn't the real world. And you have to analyze businesses. Some businesses are going to be subjected to enormous competitive pressures that aren't extant today. And we made that mistake, for example, at Dexter Shoe. I mean, we bought a business that was earning $40 million or so pre-tax, and we assumed that the future would be as good as the past. And we couldn't have been more, I couldn't have been more wrong. So that was a case of projecting into the future conditions which were not going to exist in the future, competitive conditions. That's part of business. And I will tell you that 20% of the Fortune 500, but I don't know which 20%, are going to be earning, significantly less money probably 5 years from now than they are today. And that's what the game is all about, figuring out what those future cash flows are likely to be. And when you feel you can't come up with reasonable estimates in that respect, you move on to the next one. The intrinsic value of Berkshire, like any other business, is based on the future amount of cash that can be expected to be delivered by the business between now and Judgment Day, discounted back at the proper rate. Now, that's pretty nebulous. Another way of looking at it is to try and figure out the value of the businesses we own presently, and we try to give you the information
that will enable you to make a reasonably close estimate as that. We own lots of marketable securities. It's probably safe to say that they are worth more or less what they are carried for. And then we own a number of operating businesses, and we try to give you the figures on those businesses that are the figures that we use in making our own judgments about the value of those businesses. Now, that tells you what we have today and more or less what it's worth. But since Berkshire retains all of its earnings, it becomes very important to evaluate what will be done with those earnings over time. I mean, it is not only a question of what the present businesses are worth. It's a judgment on the efficiency or the effectiveness with which retained earnings will be used. If you had looked at the intrinsic value of Berkshire in 1965, we had a textile business that was probably worth about $12 a share. But that was not the only part of the equation, because we intended to use any cash generated to try and buy into better businesses than we had, and we were fortunate enough to be able to buy in the insurance business in 1967 and build on that. So it was not only a combination of the business we had, but the skill with which retained earnings would be used that determined what the present value actually should have been at Berkshire going back that far. It's the same situation today. We will put to work billions and billions of dollars this year, next year, the year after. If we put that to work effectively, each dollar has a greater present value than a dollar has simply in cash or distributed. If we do it ineffectively, it has a value of something less. The businesses today, we have whatever the figure is in the annual report, roughly $80,000 in marketable securities. If our insurance business breaks even, that $80,000 is free to us in terms of using it. And we have a group of operating businesses, and we show their earnings in the report, and we're going to try and add to those, and they'll try to add to their earnings. But if Charlie and I were each right now to write down on a piece of paper what we think the intrinsic value of Berkshire is, our figures would not be the same. They'd be reasonably close.